Just a couple of bills a month, invested consistently over a period of time, and you're a millionaire. It's really as simple as that. But where do you get started? Through this video, I'll be telling you all the important information you need to know and how to get started investing in the stock market. Make sure you stick around to the end of the video to learn how much of my money is invested into the different types of stocks. Wagwarn people, welcome back. For those of you who don't know, my name is Benje. I'm a business owner and a third-year university student. Here I aim to help others by sharing my own struggles, experiences and advice. If you like what you're about to watch, I'd appreciate if you subscribe below, hit the like button and left a comment. If you ever want to reach out to me or you just want to see more about me and my personal life, feel free to follow me over on Insta at benje.gs. Before I start, I would just like to say I'm not a financial advisor and all information in this video is for education and entertainment purposes only. Boom. So earning the passive income through stocks is made out to be something really difficult, but it ain't at all. All it takes is an understanding of the different types of stocks and how you can invest. You can almost guarantee millionaire status by the time you retire by investing as little as £100 a week or £400 a month. All the methods of investing I'm going to talk about today are long-term strategies. Now the first thing that you need is a bill a week to be able to invest. Now if you don't have this money left over after all your expenses and your bills, then don't worry about it, it's not the end of the world. There's many ways in which you can achieve this. You can cut back on some of the unnecessary purchases in your life, use price comparison websites to see if you can save on your bills, aim for a promotion, or start a side hustle. I talk about 3 different side hustles that can make you a bill a day in another video. It's also key, and I cannot stress this enough, to have a 3 to 12 month emergency fund. I've talked about having one of these previously on the channel, but it should be the underpinning of any investments that you do. By having 3 to 12 months of your monthly expenses saved, it gives you extra peace of mind knowing if the worst happens that you're covered, whether this be losing your job or unexpected costs come up. I'm not a big advocate of having your money in the bank, but this is vital, and you can use a website like moneysupermarket.com to find the accounts that pay the highest interest rate. The second step is knowing what you can invest in. There are many different ways of investing into stocks and many different types of stocks. But the first thing you will need is a broker. There are many different brokers out there that offer slightly differentiated services. But for all my stock market investments, I use Trading 212. If you use my link in the description, when you sign up and deposit a minimum of £1, we'll both get a free share worth up to £100, where you can then sell it for an instant profit or hold it in your portfolio. Once you have your brokerage account, you then need to decide on what type of investing you're going to do. It can be hard to find the next big company with thousands publicly traded on the stock market, and as John Bogle, the founder of Vanguard, once said, don't look for the needle in the haystack, just buy the haystack. This is the simplest type of investing, and it's done by investing in an ETF. ETF stands for Exchange Traded Funds, and these funds track different industries as well as stock market indexes like the S&P 500 and the Nasdaq. Hey boy, slow down. What's a stock market index? A stock market index is a selection of stocks that helps investors compare current and past market prices in order to calculate market performance. One of the most known indexes is the S&P 500. This contains 505 differently weighted companies, including the likes of Tesla, Amazon, and Apple. The companies within this index are reviewed every quarter, so only the best performing companies are in there. You can invest into the S&P 500 Index ETF on a brokerage platform like Trading 212, and from the 1920s to 2019, the S&P 500 averaged an annual return rate of about 9.8% a year. What this means for you is that if you consistently invest your 4 bills a month into the S&P 500 ETF over the course of 40 years at a 9.8% annual return rate, you have 2.3 M's, baby! If you did this exact same thing but for 20 years instead of 40 years, you'd only be sat on about 295 bags. This is the power of compound interest and why it's so important to invest on a consistent basis. The next way of investing is through dividend stocks. Whenever you buy a share, all you're doing is buying a small percentage of that company. So if you buy some Apple shares, then yes, technically you do own part of Apple. Some companies that you can purchase shares in also pay a dividend. All this is a sum of money paid to its shareholders from its profits. This typically happens on a yearly basis, but can also happen biannually, quarterly, and sometimes even monthly. Companies who offer dividends all offer them at different rates, usually no higher than 8 to 10%. The typical dividend for a company in the S&P 500 who offers one is around 2.5%. To put this into context, if for example a company had a profitable year and decided to pay a dividend of 100 bags and you own 1% of this company, you'll be paid a £1,000 dividend. When investing in dividend stocks, it's imperative that you choose good stable companies who offer a dividend like Apple. Without doing this, you'll be left with a company that is forever making losses on losses year after year, and so never pay a dividend, but also the stock price is decreasing. Apple's dividend yield is 0.68%, and you'll often find that these larger, more stable firms offer a smaller dividend yield in comparison to those who are smaller and more speculative. Just because a company has a higher dividend yield does not mean it's a better investment. The final type of investing I'm going to talk about today is the one I do the most, and it's investing in growth and speculative stocks. The majority of these companies do not offer dividends and instead choose to reinvest the profits back into the business. With growth stocks, you are investing in the growth of a company. These are companies that have good foundations and fundamentals, but still have a long journey to go and a lot more growth in them. One of the major holdings in my portfolio is NIO. NIO are a Chinese electric car manufacturer who have upsides and a price target of $90 per share in my opinion. This is over double what the share price is at the time of recording. With absolutely any investment, it's important to do your own due diligence and research. This is so you know exactly why you're invested in a company, know any catalyst that will help you reach your price target, and so you are not worried in any market sell-offs, corrections or crashes, and instead see these as extra buying opportunities when the shares are on sale. Investing in the stock market is all about having no emotions and seeing things in the long term. I'll be doing a full video on market emotions, but it's imperative that you know exactly why you are buying shares in a company so you're able to stomach any turbulence and not worry if your investment's going to the red. It's important to set both your buy targets and your price targets, but also rebuy areas and areas where you will take profit and turn your investment risk-free. I usually do this at around 1 or 200% up. Speculative stocks come with more risk than growth stocks, as these are companies with little or even negative earnings and are very volatile. However, with more risk comes potential for more upsides, which means potential for more profits and more rewards. You are often buying into a company hoping that they will produce on an idea that they have. You're able to mitigate this risk by doing your own in-depth due diligence on these companies. And as Warren Buffett once said, risk only comes from not knowing what you are doing. Consistency is key when it comes to investing in the stock market. You will not get rich quick by any means, but you are able to put yourself on a steady path to becoming a millionaire with minimal work. It's important to be highly diversified in order to reap the benefits of every single type of stock investing. I've got the majority of my money sat in individually picked growth stocks, taking up around 50% of my stock portfolio. I've got around 30% invested into ETFs to benefit from the built-in diversification, and I've got around 15% in dividend stocks. The remaining 5% is in speculative plays. This allows me to have steady portfolio growth over time, but also allows me to invest in riskier plays with higher upside potential, as I am not a risk-averse person, but I also do understand the importance of spreading my own risk. If you like this video or gain some useful advice, I'd really appreciate if you subscribe below, hit the like button and left a comment. Feel free to follow me over on Insta, and we will see you again soon.